Hey folks, welcome to a product review at Finominal. Today we're going to look at Pacer's Trendpilot US Large Cap ETF, which trades under the ticker PTLC. The ETF manages around $3 billion and charges a 60 basis points management fee. The strategy is quite simple. It is either exposure to US large cap stocks or US T-bills. And so we can call it a tactical asset allocation strategy. And the way that PTLC determines allocations is quite simple. It looks at the 200-day average of the S&P 500. If that is positive, you allocated equities. And if that is negative after 5 business days, you allocate 50% to T-bills. And if it's 20% below the 200-day average, then you allocate 100% to US T-bills. So it's a very simple strategy. So let's explore in terms of what makes this product so successful, given $3 billion under management. Now, the right benchmark from our perspective is the S&P 500, because this product, although does have kind of exposure to treasuries, right? It effectively tries to offer more favorable returns, at least on a risk-adjusted basis, than the S&P 500. Now, we can see that this product was launched in 2015, and since then has, well, underperformed the S&P 500. Having said this, this product is largely about risk management, having a smoother ride than the S&P 500. So we can also look at the volatility, right, which is lower, 13% versus 18%. We can look at the max drawdown, which is lower as well. But we also see that the Sharpe ratio was also lower than that of the S&P 500, which is not that great, because you'd expect this product perhaps to generate lower return, but a higher Sharpe ratio. But more about that later on. We can do a quick returns-based factor exposure analysis to see the shifts in allocation across time. So here we do see the factor betas to the S&P 500 and the kind of US bond market. And we can see, oh, it fluctuates over time, as expected. And we can see down here, the basic risk sources over time, which was primarily the S&P 500, right? Because in that time period, the S&P 500 was largely in a bull market, and the contributions from bonds was on the lower side. Now, let's have a look at terms of the risk profile. If this ETF kind of like has achieved to provide lower drawdowns, and we've already seen that the max drawdown of PTLC over the last 10 years was lower than the S&P 500. But if you look at a kind of like a drawdown analysis, we do see here that in most periods, right, when the market went down, 2016 or during COVID, actually PTLC didn't do that much better. It did do better in 2022. And this kind of highlights the nature of PTLC and also the market of the last 10 years, right? That this is a trend following strategies. You're going long when equities are trending positively, and you allocate away when they're trending negatively. That these kind of slow moving trend following systems work better when markets themselves trend slower, right? Rather than very quick recoveries during COVID, right? Where the market dropped by 30%, but then recovered very quickly. Now, this is with regards to PTLC. So this first impression is not a very favorable one, right? We have to acknowledge that the last 10 years was a time when market downturns are very quick and recovers, which are often supported by central bank intervention, right? But what we can do to get a longer term perspective is look at the index that Pacer Trendpilot US Large Cap ETF is tracking. And this index has a track record going back to 2000. Track record is the wrong word, right? But the returns are available since 2000. And we can look at returns in a second, but let's actually kick off with risk, right? So here we effectively have the drawdowns from 2000 to 2025. And here, of course, see what makes this product attractive. And namely that when in 2000, 2001, right, the S&P 500, driven by the implosion of the tech bubble, started its kind of like 50% decline. This product quickly went out of equities into T-bills. And the same thing happened during the financial crisis again, right? So we can see these quite significant drawdowns of 50% in the S&P 500, right? A lot of investors nowadays haven't experienced that so far. That this product protected you in those cases, right? And that also does have an impact on the kind of long-term returns, where again we can compare the PTLC index versus S&P 500, right? And effectively see that it has kept, generated the same return. Having said that, over this 25-year time period, it has had a much lower volatility, 12% versus 19 for the S&P 500, and a high Sharpe ratio, 0.49 versus 0.3. And of course, the drawdown, right, was half, negative 26%, compared to the negative 55 of the S&P 500. So that's great, right? So the track record of the actual product, right, doesn't look that great, right, the last 10 years. The long-term perspective does favor PTLC quite strongly, right? However, we could be challenged, right, in the sense that this long-term perspective exactly starts when the S&P 500 enters a bear market, right? If we change the rebalancing period to, let's say, 2010, right? So now we have 15 years of data, so this is more medium-term perspective. Then again, the perspective changes in the sense that the S&P 500 looks much more attractive. And that's, of course, post the financial crisis, right? And post any significant bear markets, right? And this, unfortunately, is the conclusion about this product, right? That in general, it is effective over the long term, but for it to really create value for investors, it does require long and slow bear markets where it reallocates out of equities into US T-bills, right? And effectively preserves capital. If you do have a market where you have sharp drawdowns or like market crashes, right? But also sharp recoveries, right? This product will not perform very well, right? Because it's slow moving by the nature of the trend following system using the 200-day moving average. It is worth mentioning also as a final point that this product is expensive at 60 basis points. I mean, this strategy is something that you could replicate in Excel and do it yourself. Having said that, there is a benefit to having this new product, primarily via taxation, right? Not so much that it requires less work, right? But if you do this yourself, right, capital gains taxes will be incurred. I hope this helps in terms of analysis, right? As mentioned, a bit more complicated perspective, favorable on the long term, not so great on the short or medium term. So this is a product, right, where people will have different opinions, right, if it is used or not. Hope that helps. Have a nice day.